In today's session, I and Gary plan to discuss business and accounting methodologies, operational strategies, as well as best technology stack, workflows, and best practices. So I want to jump right into this session outline. As you can see on the screen, I think we'll start with discussing different challenges that we come across from the facility owners, whether they are financial and management related or accounting related. Each one of us will share our viewpoint and our experience, and then we'll jump right into the best practices and what we have as our top suggestions. So that being said, I would request, Gary, if you would like to share the type of challenges you come across when you talk to either upcoming facilities or ongoing one they're struggling from the financial and management side. So all yours, Gary.
Sure. Yeah, sure. Thanks, B. So, as I mentioned in my introduction, we help facilities from the startup side, and then we also do help facilities with an audit. So, management, when we go to do an audit, we find that the management systems that people use either don't provide the right information to the ownership group or the management team, right? Not allowing them to properly manage facility or make strategic business decisions. And then when we start up, obviously they're new businesses, and we try to give them a technology stack, which B will present a little bit later, of certain softwares outside of your some of what you may not normally think of, right? That actually work all together hand in hand, and then can create a business flow so your general manager isn't spending all day doing accounting, doing bookkeeping, doing payroll, um, spending time with customer service, right? If you're not using proper proactive customer service tools. So the management systems just are a key component that kind of wrap everything together. And as we go through this, you'll see where analytics kind of helps you manage all those systems together, right? So they work in a straight flow and work in a straight flow. The next thing that we normally see is cost control. I know I've seen some people that popped in on here. A couple of you guys know me pretty well, and we've gone over this stuff. But what we find a lot of times, and I would say if I've done 50 audits, 40 of the that we did audits for have the issue where they actually don't know what their costs are, right? So they don't properly align their cost correctly against their revenue stacks, and they may be running programs where they think they're being profitable and not running a different program, and basically short selling themselves on their revenue per hour or their ability to make money. An example of that would be, not running a birthday party because you're going to rent a facility out and do a rental hour versus running a birthday party. So there's a bunch of different types of things like that. But if you don't know what your actual costs are, that can be a tricky thing for you. And the next thing is budgeting. We find that very, very few facilities actually budget, right? So I, it startles me when I go to a client and say, well, what's your year over year? Where are you at budget versus actual for what you have? What is your recommended growth? How much do you feel that you're going to grow this year? And the answers are mind-boggling. We just don't know, right? It's throwing a dart at it. Well, 10%. Well, 10% across the board, or is it 10% in this and 5% that? Where are you at in your business life cycle, right? So if you're in years 1, 2, and 3, right, budgeting is different than if you're in years 4, 5, and 6, right, or 7, 8, 9, 10. So having a budget, having the management prepare a budget for the ownership group, getting buy-in from the ownership group and from the management team, and then sharing the budget with your middle managers, right? So your program managers, your youth programming manager. We find oftentimes when we do an audit that a youth program manager has no idea why they charge X amount of dollars for class or Y amount of dollars for a birthday party, right? It's just something that somebody told them to charge, and that's what they charge, and they actually have no idea. So from a budgeting standpoint, creating a budget from the owners, from the management and ownership team down, and explaining the budget, sharing the budget, and actually going through financials at a relatively high level, simple level, based on, operating expense for their departments, will go a long way in having everybody in your team understand what the financial goals are. So budgeting, if you're not doing that, is just a key component to set that apart. Um, Trends and innovations, right? Staying abreast of trends. There's tons of trends, right, in the industry. Some of them are revenue generation trends, but a lot of them are cost saving things. Like, have you switched over to LED, right? Have you explored solar? Have you added in a different technology stack as far as potentially a uh, what am I saying? A social media platform, right? That takes away a huge amount of time on your staff posting things where everything does automatically. Your email service provider, right? So how easy is it to create emails, send emails, and to pull data from your management system into your ESP in order to get information out. So all those things are changing rapidly. If you're not using AI right now, right, and you're not using AI technology, and you haven't included different AI things into your technology stack, you're just giving up. You're wasting time, right? Um, Using, I know, Chat GPT, or there are other ones out there, saves hours of time, but now they become part of your technology stack, right? They will help tie in how to do all this stuff. Okay. Uh, Revenue generation, we talked about that. If you're not doing membership fees, I just had this conversation at US Indoor this year. At my presentation, somebody has said, well, membership fees, over 3/4 of the room is not charging membership fees. If you're not charging membership fees, you got to figure that out. And then all sponsorships, people are just woefully underutilizing how sponsorships can help your bottom line. And so dedicating the focus time and energy on sponsorships is something that definitely you need to look for. And then adaptability, like, it's all these things, being able to adapt to the changing consumer needs. For example, I'll use a simple one, summer camps, right? So it used to be everybody did weekly camps, right? Well, a lot of parents don't work 5 days a week, 9 to 5 in the office, and they don't necessarily need the ability to do weekly camps. They may only need the ability to do day camps. So being able to adapt into those types of things will help overall in your overall profitability. But if you do not have the proper management systems, you don't have the proper cost controls, you don't understand your budgets, right? You're not using trends and innovation, right? It actually becomes very hard to be adaptable, right? So all those things, having a very sophisticated technology stack and using technology to your advantage, will allow you to think quicker and make better business decisions, and be increase revenue and be more adaptable. So from that standpoint, that's a kind of a quick overview of each of those, and we're going to kind of go through some of these in more detail. But we should give you a quick overview of kind of what these things are. So, what do you have to add there?
I think this flows right into where you discussed more from the management and operational side, that to achieve that, I think what's important is the visibility on how we are getting to analyze that, whether we are able to properly record the revenue, whether you do have that expense matching or not. And that's where I think my role comes into the picture. And what I've been seeing so far is a lot of facilities that go with you, get consultation on the best practices that you mentioned on the management side, and then kind of comes to us. And what we find out is, we know that industry is very diverse when it comes to revenue types. There are so many types of programs. And at the same time, they all have different timing of revenue generation. Now, if you're talking about membership, it could be annual, monthly. The key is, how do we make sure that not only we're earning in the right period, but we're recording in the right period, right? That's where the complications start. So I see a lot of facilities struggling with, hey, we have this membership fees, hey, we have this many registration for this leagues. Now we have 15 seasons that they're gonna get spread out into. That's what we try and help understand their revenue streams, which is diverse, and calculate, making sure that they're recognizing the period that they are earned. For example, you may have a season flow over 3 months. That could be 20 games first month, 35 in second, and 40 in other. We want to make sure that the revenue is spread equally from the registration, to make sure you can do that matching of revenue to the time. you're recording in the right period. Say it kind of flows through the expense matching as well. Now, not only you want to make sure that your revenue is recorded in the right period, but you want to make sure the expense follows it. A lot of, for example, cost of utilities, maintenance, staffing can vary significantly based on the usage of facility, based on the game schedule, whether you're paying to referees and things like that. The tracking technology from the accounting side, the accounting method matters to make sure that we are matching expenses. Couple other items that I come across from the accounting side is the industry is heavy on assets as well, whether it's buildings that they own or sport equipments that are heavy, needs to be capitalized, technology that they own, tracking those assets and managing their depreciation based on the right method they want to choose. They need help there. Similar thing goes with concession items that you may be selling from the inventory management perspective, right? You want to make sure that you're tracking the inventory at right place, their valuation is accurate, whether you're following first in, first out method and things like that. While you are working hard to make sure that you're generating enough revenue, you also want to focus on you are accounting for them, whether it's through technology or whether it's through professional help. You're hiring professionals to do your accounting, things like that, right? A lot of others that you already discussed, Gary, the importance of budgeting and forecasting. Now, it's one thing to understand that you need to budget for it, but to create the basis for that, you need good numbers on, okay, what was the real revenue I made for this season or that season? That's where the base of the numbers are coming from, either accounting software or your accountants. And how you view it is the reports that you get. Now, your reporting requirement could be more focused on just cash management, if that's what the goal is, but it kind of extends more into other KPIs and dashboards where you want to, kind of get to more analytical information on like, okay, what is my profitability by a program? What is my revenue per league and things like that. I think if you want to go into that minute detail, we want to make sure that we are accounting for them right. That flows into technology integration. I know you talked a little bit about from the operations side, there is certain technology important to make sure that it has capability of creating right programs, assigning right revenue or right cost to each programs. But it's also important to make sure that we have a good technology software that you're using when you come to your accounting piece, right? And we might have going forward, next couple of slides will cover a lot of suggestions on what could be the best technology stack you would like to use or you should be using based on your specific requirement. But at the same time, when we consider technology, you talked about ChatGPT and AI, and that kind of flows right into the security part, where if you're not knowledgeable enough on what technology you're using, you're really not sure that how much investment they've done in their data security to ensure that not only your data is secure, you're not, vulnerable to the criminal market, right? For all of that, a lot of times facility owners come to us for just a piece of help here or all of the help here. So I think we kind of talked about the challenges across the board. We want to talk a little bit about our opinion on what could be the best practices. While I jump right into it, Gary, you want to talk a little bit about picking the technology stack within from the management and operational perspective, and what we can talk about other aspects too.
Yeah, so before we jump into that, let me kind of throw some questions out there just for
Sure.
general questions for people to think about, right? And then it might encourage you some people to write a question or comment. But does everybody on this call, everybody on this program, managers, and I see there's some managers and some owners, I know some people that are in here, do you actually know what your total collection percentage is for your leagues, right? Or your total collection percentage for a program? Are you giving out discounts, right? So if your league fee is $1,000 a team, are you collecting 95% of that revenue? Are you collecting 100%, right? So, or are you tracking that, right? Um, Other thing is one of the key things is if you have a youth program manager, for example, or and they manage Little Kickers or child development program, and they do your birthday parties and potentially do summer camp. Do you apply their annual salary across those three revenue stacks, right? So if you're not doing that and you just put them as management payroll, then you don't really effectively know what your true margin is and whether or not you're charging enough for those programs until you apply some overhead costs to that, right? So that kind of goes into, do you know what your revenue is by program, right? So if you were to say to yourself, write down on a piece of paper, birthday parties, right? I made X amount of dollars and I spent Y, right? Can you actually track all your expenses back to that revenue? And do you actually know your operating margin for that program? Same with leagues, same with uh, summer camp, right? Maybe days off school camp, or maybe it's something with rental. Obviously, rental has no margin, right? But you might be doing rentals instead of doing a child development program, right? Because, if your buddy's is the director of the lacrosse club or the soccer club, and he has to have 40 hours a week of training, right? Well, you're getting $225 an hour for that court. If you run a class, right, and you have 10 kids in the class paying $25 an instructor that costs 30, which one's making more money, right? So if you don't understand those types of margin, you don't understand your operating percentages, right, then you're going to make bad business decisions. And when you look at all of your operating margins by program, right, what is your collective operating margin, right? And we're going to show you how to track that in a second. But if you don't know those things, right, then it's very hard to make a business decision as a manager as to what programs you should be running and how you allocate your time. So we're very much, as an analogy, right? If you go to a golf course, there's only so many tee times, right? Well, the prime tee times at 7 in the morning are more expensive than 2 in the afternoon, right? If you go to a hotel, right, B might get a hotel reservation for X and I had to pay Y, right? If you go airline ticket, right, same thing. If you go to a storage outside storage company, right, to store some stuff, what you pay is all variable based on what the supply and demand is, right? So if you're looking at margins, right? All those things have something to do with that and with supply and demand. So it's a lot harder to be the owner or general manager of a indoor sports facility than people give it credit for. I have found a majority of owners that I come in think it's like open a lemonade stand on the side of the street, right? We just build a facility and people will show up, right? If you're a GM in this business and you don't know HR, you don't know accounting, you don't know marketing, right? You don't know operations, right? And you're not fairly good at all those things, right? You're going to struggle at some point, right? So just those are things to look for. What is your revenue per square foot, right? So what is it, right? So you made X, you spent Y, right? How do I calculate my revenue per square foot? What is my margin against that, right? What is your, what is your proper operating margin? What is your proper operating cost against revenue, right? What is your proper debt service formula against revenue, right? So these are all things that when you go to a bank and you want to get a loan and you say my total revenue is going to be 3 million and my debt service is going to be based off of 20 million, right? There's a debt to equity ratio that you're going to have to come up with. Well, it's similar to what you guys are doing on a daily basis and how did that work? So if you don't know all of those numbers, right, it's very hard to figure out your success. So if you have any questions on some of those numbers I spewed off, I can give you some help on those numbers, but you should know those numbers and should be able to track those numbers. And we're going to show you some tools on how to track those. So any question on that, just jump in anytime and I'm more than happy to help out answers, but we'll move on to kind of the platform here. So picking the right technology stack. Um, we're not here to promote different types of businesses or different types of things here. We use all of them, right? So whether you use Easy Facility for your software to run your business, whether you use Upper Hand, whether you use Bond, whether you use uh, Day Smart Recreation, right? All of them have different pros and cons to what they use. I use actually all of those in multiple businesses that I run, and I pick and choose which management software system I'm going to use based on what the programming type is in my facility, right? So if you're doing a lot of league and instruction type of thing, you're one of those softwares I recommend. I'm not going to tell you which one, but one of those softwares is much better at handling coaching, training, tracking instructional hours, right? Some are much better at online registration, right? Or online booking, right? Some are much better at giving you different financial controls and reports in the backside. So there's a bunch of different things, but knowing those different types of things is the first key in your management system, right? General ledger standardization, we're going to kind of go through that, and these next three kind of all go together. So, general ledger standardization, tracking to get profitability by program, and allocating the proper wages to COGS, right? These are all kind of one combination
Yeah.
of things
Well,
that go together. And then we're going to show you a sample of a simple COGS platform, and we'll walk through it and kind of show you how you can track all these types of things just by setting up your accounting in a certain way. And somebody's going to see this and be like, "Oh my gosh, I can't change my general ledger. That would I would be so far off. It's so confusing. There's no way I could do it." I can tell you I've personally done it for over 15 different companies in the industry, to where we come in and look at their books one way, and I ask them what their margin is on their child development program. They literally have no idea what their cost of goods sold are, and actually whether they're profitable or not. And once we made these changes around, right, it's about a 1 year kind of module to kind of get organized and get everything set up. But then they can easily, very quickly, and figure out what those margins are. So B, you want to throw that
yeah.
up there? Okay.
Yes, before I do that, I want to insist on what you just said about technology stack for a second, is we're not promoting
Yeah.
anything. The goal here is to make sure that you're putting enough thoughts into this to make sure that you're picking the technology, whether it's a POS, accounting software, AP software, anything that you're doing, you're putting some thoughts into. It's important to have that best technology to make sure that you're tracking it. Similar to POS, there might be a lot of accounting software that may be your option. It depends on your size. It depends on how complicated your structure is, how dimensional your structure is. And some of the example is like, if you have multiple locations, one technology could be better, but if you have multiple location, multiple facility at a different EIN, but you also have different programs, and you under the programs you have multiple dimensions, then there could be a different set of technology available for you. The point is to make sure that you're able to evaluate that properly and pick the right technology. Same thing if you have 5 bills to process versus you're processing 500 bills a month, you want to pick whether you still want to do manually or want to put an AP process application to make your life easier, faster, and you can analyze your cost benefit. So just overall, the best practice is to pick the right stack that's right for your industry, your size, and go with it. Now that flows right into the general ledger standardization, and I'm going to show the example of what Gary was just talking about. But important is, how do you get there? There is a technology part that kind of plays picture into this. So Gary, you want to kind of talk through this
Sure.
a little
Yeah.
detail?
So on the left-hand side, these are your revenue accounts, right? So this first section in the green, these are all revenue pieces. And so each one of these, when we say sports revenue, a lot of this is broken down sometimes where the GL code 4000, instead of being sports revenue, would just be court sports, right? And then 4100 would be a sport, right? And then each sport would have these four subcategories underneath there. So, and most of you guys are, if you're sitting here thinking, if you're running if you just use soccer for a simple example, because most of us run soccer, right? You have instructional piece in soccer, right? You have camps, clinics, and classes. You have leagues, and you have tournaments. Those are basically your four primary revenue categories within each sport section. Now, in each sport, there may be some things that are different, right? But as a general rule, this is where you're what are going to be there. So as you can see here, we have our revenue stack, right, for each sport. And then on our court sports, like we mentioned, right, you have basketball, volleyball, futsal, other court sport, any whatever court sport that you have, each sport would have its own column, right? Its own column set across here, and then its own set of revenue. And when we set this up, so this is in using QuickBooks for those most of you guys use QuickBooks. This is what we call a class system. So setting up your QuickBooks into a class system, and this is what it would look like. So when you pull the report, when you pull your profit loss statement, it would look like this. So your sports would be across the top, right? Your revenue silos over here would be on one side, right? And then as they go down at the bottom, you'll see cogs, and we'll talk about that. So this is just standardly what it looks like. So very quickly, I manage 10 or 15 facilities at a time. I can get the monthly P&L, right? And if the cogs are set up this way, I can look by sport, right, against the cog very quickly and find out if they're at the right operating percentage, right? So I can look at summer camps. We just got done with summer camps, or we're 4 weeks into summer camp, and I can look at the cost of goods sold, right, against the summer camp revenue very quickly and determine if they're in the right margin, right? Ideally, we're going to talk about this ahead of time, right? We're going to know what that margin should be, right? And we're going to manage this doing budget versus actual, right? So we're going to know that in January, when we start our summer camp marketing, right, that our total budget, we should be at X amount of our total budget by the end of January, right? By the end of March, we should be another step closer, right? By start of summer camp, June 15th, right? We should already be at a percentage of gross, right? And if we are tracking that the right way, and we know our historicals of how we grow, right, we can manage whether we're ahead or behind, right, using budget versus actuals and year to year over comparisons, right? If we're tracking that correctly, and we may need to juice our marketing, right? If something may have happened and we may have had another competitor that came in, right? So these are all things, if you track your cost of goods sold properly, track revenue properly, and use a budget, right? It allows us to be more adaptable, as we said earlier, right? Be more nimble, right? And change our marketing strategy or change what we're going to do to potentially and drive more revenue. And some of those are immediately returns, and some of those we might figure out over time and have to improve them for the next year. But either way, you're going to be able to find those, right? The second section here is rentals. Obviously, there's not a lot of costs in rentals, but they get applied to each sport, right? You should be tracking your rental by sport, by category, right? So if you can track your basketball revenue versus your volleyball rentals, right, that can be useful for you. Um, Open play, it's a new line item. It's super popular now. Birthday parties, right? So different if you have different packages, right? Party food, party add-ons, party tips. Include your tips as revenue, right? And then you get an expense it right back, right? It's a wash through, but track your tips, right? This is a good way to kind of show your employees that, oh, I don't want to do birthday parties, right? You're like, well, last year, our birthday party coaches did, $20,000 in tips, right? If you have that tracked, it can show that you're pretty quickly going to find people that might actually want to do birthday parties, right? Um, Corporate group events. So this is kind of all these different revenue stacks. You may actually run your own youth club, right? If you run your own youth club, it has its own set of revenue. So don't put your youth club revenue underneath soccer if it's a soccer club, right? That's going to be a whole other section of revenue, and it's a whole other set of cogs. So you can manage that as its own business unit within inside your business. So I see that a lot where people will actually run their club business P&L through their silo of a sport, right? Versus having it broken out on their own. Um, Down into cogs, the first and most important one of here is your director. We talked about earlier. If you're not applying your overhead management cost to your programs or a portion of that, right? Then you're doing a disservice on what your actual P&L is for that program. Instructors, staff, referees, equipment and supplies, awards, advertising, right? I see everywhere I go that there's an advertising line item in our general operating expense, and so that's not where it goes, right? Most of your advertising can be attributed to a revenue stack or a revenue stream. So if you're doing marketing specifically and you're doing Facebook ads or Google ads, or do a magazine ad in a local children's magazine, and it's for birthday parties only, right? Apply that cost against the birthday party, right? If you're doing child development little kickers and you're doing specific little kicker child development ads in the marketplace to drive revenue, that those advertising cogs go against the program, not in your general cogs, right? Uh, so just those are, if you're not calculating those, your percentages are never going to be right, right? You're going to be misled as to what you're charging. For example, you know, I have clients that use little kickers for an example, right? That charge anywhere from $16 a class, right, to $25 a class, right? And some people will say, whoa, they charge $25 a class because they're in Seattle or Chicago or New York or Boston. And somebody in Des Moines, Iowa will be like, oh, nobody would pay $25 a class, right? Until you go out and look around and figure out what people are actually paying, right? And people pay $20 to $25 a class for gymnastics, for all other types of activities that require coaching, right, or require some sort of coaching than you will think. So just always make sure that you're doing that, because once you find you raise your class costs from 16 to 20, right, your margins will jump in line pretty quickly, right? And if you haven't raised prices 2 years ago, 3 years ago, I think it was, I'm not sure. I did a whole presentation on inflation, right? Inflation is still here, right? Inflation hasn't really gone down much, right? A little bit here or there. If you haven't raised prices every year for the past 2 or 3 years, you're giving away money. People understand that things cost more money and they'll pay, right? But you need it. But those things are important things for you to stay on top of, right? But this is how the cogs work. If you're not doing cogs like this, if you can't figure it, if you don't have multiple revenue buckets and have cogs assigned to revenue buckets or revenue silos, we want to call it, then you're doing yourself a disservice. But this is something that you certainly would want to look into changing over. It will solve a lot of problems for you.
Yeah, thank you, Gary. And I think that the format, the general ledger standardization gives you opportunity to make sure that you can track profitability by not only sport, but by program. Couple of things that you want to, also see that, for example, rentals, are you using cash-based accounting or accrual-based accounting? That matters when you are tracking these numbers, right? You have a registration in this month, but event schedule for next 5-6 months. You want to make sure that you're calculating and putting it right in right bracket for that month. So you are also tracking referees and staff expenses that are attached to those events in here. So if you truly are following, it's still a choice whether you want to, follow cash-based accounting or accrual-based accounting. But most of the practices that I've seen across is like a hybrid method where you're still trying to make sure that you are allocating your revenue to the games that are scheduled, to the events, their birthday parties, to those particular parties for that day, because a lot of times blocking a week or a month of time, right? So going backwards a little bit on the best practices for a startup, for an onboarding phase for a startup facility, I think it's the right time to making sure that we not only doing the technology stack picking right, but also doing the general ledger standardization, reorganizing your chart of account to incorporate this dimensional level setup. One thing that you might have noticed, not only you can do that, but you can add, if you have multiple location, you still can have that setup. Sometimes you have more than one entity that goes on the top level. So once you decide the hierarchy, now you have more visibility on how consolidated your reports are going to look like. For example, you want to just run one location and you want to know how profitable that location is compared to other location. Same way, how profitable one sport is compared to other. This setup is going to allow us to provide reports, comparative budget and actual comparison, a lot of KPIs. You can also compare this with benchmarks, what is available in industry and things like that. But for that setup, I think this is an ideal way to visualize your revenue.
Yeah. So one other thing on the technology stack, on your payroll company, your payroll provider, your employees, you must be able to put them against revenue. So for example, if you have a front desk worker who also coaches in the child development program and also does birthday parties, right? When they punch in for an 8 hour day on a Saturday, it's their big day. They may start off doing child development classes, work the front desk for 3 hours, and do a birthday party. They may get a flat rate pay for a birthday party, $50 to do a party plus tips, right? They may get paid $15, $17 an hour to do front desk, right? And they may get paid $20 an hour to coach a class, right? They need to be able to take their 8 hour day, right? And punch in and track their hours, right, accordingly into your payroll provider. And I don't mean that at the end of the week, the GM goes and sees that Susie worked 20 hours and then the GM manually puts all those pieces into the right place and puts them into QuickBooks, and the only thing that their payroll provider tracks is that Susie worked 20 hours, right? So if your payroll processing system that you're using, right, does not allow you for your employee, not your general manager or not your owner or not your program manager, to reallocate hours of an employee to the against the proper revenue stack, then I would say that you need to look into a new payroll provider in order to make that a seamless process where it's the onus is on the employee for 90% of it, right? It needs to be reviewed, but the employee is 90% ownership of making sure that their allocation is done correctly, right? So the owner really just or the manager takes a quick snapshot, look at it to figure it out versus having to go through all 40 employees and assign their hours across the thing. So that's a huge piece of the technology stack, saving time for everybody involved.
Yeah, and the second technology stack is just account payable applications, whether you're using, there are a lot of options out there, whether you're using Bill.com or Ramp or something like that, helps you, not only code the bill, classify the bill in the same categories that you worked on to create that general ledger standardization. You should be able to allocate your AP bills to proper sports, proper program, and proper GL account. And a lot of these applications also integrate with your accounting softwares, making your life easier. When you're processing the bill, it gets pushed into your accounting software, also get categorized the way that you want to categorize it. That is, following that expense, following revenue, right? So I think that when all the technology stack comes together, the right POS, right accounting software, right payroll software, and right AP process kind of gives you a ssolution that can provide you all of the other important aspect of accounting. We talked about revenue recognition a lot. We want to make sure that you are recording revenue in the period that they are not in the period that they're collected, right? But dashboards and KPI, a lot of accounting software itself has very advanced dashboards to provide you all the KPIs that Gary talked about, revenue per square feet. You want to do all of that calculation and use that for your operational benefit. You need that capability to review those reports and KPIs. I talked about multi-location consolidation. You want to look at company as a whole, but you also want to look at independent pieces of the company, whether they're independent sports, independent location, or independent programs. So I know we discussed a lot. Gary, do you want to pause and take questions if anyone has?
Yeah, if anybody has a question, throw something out there.
Yep, we do indeed have a question. It came in from Michael Lee. He put it in the chat. I'll read it off. And Michael, feel free to unmute yourself if you want to add to it or ask a follow-up. This was to Gary. He said, you've helped our facility with ideas on margins we should be striving to meet per program/class type. You also explained that those margins are without program director costs. If we aren't or are not including program director costs in those margin calculations, do you have suggestions for how to ensure that the overall program revenue is where it needs to be relative to those director costs?
Yeah, so if you don't include your director's costs in there, then the margin changes a little bit, right? So if let's use an example of a league fee, for example. So if you're running the league, right, your referee costs are going to be roughly 17% of your somewhere between 17 and 21% of your total revenue, right? Participation awards another 2 to 3%, depending on how much revenue you do, right? And then you're going to have um, maybe some advertising costs, but maybe not a lot. So somewhere around 20%, right? So your operating margin should be somewhere between 78 and 82% on a league. If you apply, if you have one guy who does nothing that you pay $50,000 a year and he runs your soccer league and that's all he does, right? Okay. And that's all he does. And I see it all the time. Then if you apply his $50,000 against that soccer league, right? Then you're not charging enough for your soccer league because you're not going to be making a high enough margin, right? So that's what I mean by applying the directors of cost there. So that margin will change a little bit. I will give you a standard rule of thumb. Um, your total COGS against your revenue, right? So your total direct expenses, right, against your revenue, when you add them all together, rentals have basically zero expenses, leagues have roughly 20% expenses, birthday parties have roughly 45% expenses. So when you add them all up, you should come up to about 65%, right? So if you're at 65% of total revenue is your direct COGS, assuming you are applying your COGS correctly, right? Then you're within line. You can get it down to roughly 27%, right? When you if you're running a tight ship and you're managing your expenses properly, or you're charging enough, right? Or your pricing is correct. If you look at your COGS and your COGS are 17% total against all programs, you're missing a lot of COGS into your thing because it's impossible to do, right? So there is a margin of error there, right? Somewhere between 27 and 35% of total COGS. So that would be how you would look at it. But it's very easy to take your manager and spread them across the thing. So for Mike Lee, right? If you use Danny, I know Danny's on here. So Danny's his director of business development. So Danny's in charge of soccer programming. He's in charge of the club they operate, right? So if Danny makes $100,000 a year, he's going to like that comment. He makes $100,000 a year, right? Then some of his revenue should be split against some of his overhead should be salary should be split against the leagues, some should be splitting against the club, and then all the things he does from his business development side, right, then is now general overhead, right? So it's a matter of applying those things, applying those out on how they go across.
Yeah, Gary, this is Michael. Thank you. I'm just sort of following up on the conversation you and I had because I thought it was relevant here. Because you gave us some good numbers that said if you take director costs out, I actually have things set up right now so that director costs are in. So I'm actually manually going back and taking the director costs out to try to get to try to look at those things. And so I'm thinking, well, that's kind of a waste of time. If I already have things set up with all the GLs and I have everybody's time, all the managers' times broken up with each payroll percentage wise as to where they're spending their time. I was just wondering if you had some good rules of thumb.
Yeah. I have another slide that I didn't give you, like in a deck, right? I just gave you that out of a presentation deck that has it in there when you add the people in. So
cool.
I can give it to you.
Thanks.
But your margin, Michael, your margins, as you know, right, are when you add in everybody, when you add in your staff, right, your overhead, corporate overhead, it still should be no more than 35%.
35%. Yeah.
Right. So if you don't have Danny's salary applied, part of his salary applied to those things, and you're already at 35%.
Yeah.
Right. So if you look at it that way, if you're already at 35%, then I would tell you your prices aren't high enough.
Yeah. Okay.
Right. So, I mean, that's like the simple, and you know what I mean,
yeah,
you know where I'm going with that, but that's how you know. So for those of you, if your margins are extremely good or extremely terrible, right? It's only can be two things. A, they're not tracked properly, or B, your prices are too low. Those are the only two things that can can cause that margin. Or number three, you don't have enough customers, but that's a whole nother problem,
Right.
right? I have a client, for example, that has $600,000 in salary and only does 1.1 million in revenue, right? So that would be a problem, right? Everybody on here could agree that Houston, we have a problem, right? Well, if I look at their employees, right, the type of facility that they run, they actually need all the employees that they have, right? So if I were to go in and say these are the employees you need to run this type of business, they have them all. Their top line revenue is they just don't have enough customers, right? So no matter how much I do from technology stacks and putting them right together, we have to find additional customers there. There's some prices they can raise, but they have to find more customers, and that becomes a big problem, right? But at least I'm able to find the problem. Any other ones? Questions? I know there's a couple of people over here that I've helped before, so if you want to chime in and see the pros or cons of kind of what we're talking about. But those are the things that I honestly, if I go and look at a facility, the first thing I'm going to find, I look for three things, right? Proactive customer service versus reactive customer service. And then I look at your operating margins. Those are the first two things. And then the third thing I can look at is your website. Between those three things, right, I can basically write an audit without even going to your facility, because I can find most of the issues in those three sections. If that helps you, it helps from that standpoint. All right. Any other questions, James, out there?
None have come in the chat, but I will throw one more out there. You mentioned that you're not going to, specifically endorse any particular software solution, but in your experience, when it comes to considering the options out there, are there at least one or two things that are like, must-haves when it comes to selecting a particular accounting software? Like if it doesn't have this, then look elsewhere.
Okay, so I'll name a couple of softwares and I'll give you an example, right? If you're doing, the easiest way to say it, I'm as a consultant, right? I don't get paid to put people in software, right? I use multiple different softwares, but I recently changed a client from one software to another, right? And I actually put them in software A, right? And I thought I had a pretty good handle of how they're going to operate their business, and that the software, the facility management software would work, right? And then the way they wanted to run their business, which was not right or wrong, became too complicated for the software provider that we used, and we switched the software provider and a facility management provider, and it improved their total time spent managing their facility dramatically by switching over the software. So there are, without naming who those software companies are, right? If people know me, they'll know who I moved around, right? So it's how you do that, right? I also have moved people that do a big league-based business, right? And we're using a type of software that doesn't really do leagues. It doesn't do leagues very well, right? But since their core business was leagues, the other software was great for different pieces of their business, right? But overall, the other software was better because they needed software that could manage a large league portion, and the other software didn't. So, and software changes every 35 seconds, right? So I may look at a software today and go back to it 6 months later, and they've made major infrastructure changes to it and have solved some of the issues that may or may not have been there. So I talk to all the software providers. So I'm on my phone. I can assure you that I have the connections all the way up the food chains of most software providers. And so I get asked a lot, like, what are the things that need to be put in there, or what things are lacking, and to do audits actually of software providers. So to some extent, so there are different ways to look at that.
And to add to Gary, I think, operational softwares are important, and from the accounting perspective, from the finance perspective, tech stack matters only when depending on your structure and how complicated your structure is, 9 times out of 10, normal accounting softwares like, QuickBooks and Xero and, most of the suffice the need of the structure that the industry would require. Once in a while, you're large enough where now you have to accommodate in a larger setup, ERP like Sage Intacct or NetSuite kind of fit in. This is for a larger facility where the structure is more complicated. You have multiple dimensional to track your multiple entities to consolidate and things like that. So size and complexity matters when it comes to accounting software. And I think that's similar what Gary said, depending on, something can become very complicated from the operational perspective, they may want to move to a simpler operational software. So.
And I will say, I will say to everybody on this call, if anybody calls me for help, I'm going to give you a hint. If you have the right technology stack and you currently have overhead costs and somebody who's doing, and this is going to sound terrible, but if you have overhead costs and a bookkeeper / accountant / accounts payable / accounts receivable / cash management, cash handling type of person that you're paying $45,000 or $50,000 a year, maybe more, you can replace that employee with the proper technology stack and either save the money to the bottom line or hire another employee that drives revenue. So I know that as some people don't like to hear that, how that comes out, but it happens. That's just how technology works, right? And so technology is becoming more and more sophisticated, as allows to do more and more different types of things. And when I talked about earlier about AI, right, you can do a lot of things now, right, with the proper technology stack. And it's not a matter of trying to get rid of employees, but as we know, right, if your employee is not driving revenue, right, in our types of industry, we're very small, short, tight staffed, right, it's very beneficial to you. And we all know about burnout, right? General managers working 60, 70 hours a week, right? They don't have enough MODs to cover tournament weekends and do other types of stuff. So they're working all the time, and then turn around and look and restructure their org chart, right? Give them the proper technology stack. And I just found 3 MODs, right? Which now relieves the stress on the GM, the stress on the managers, right? Allows everybody breathing room, don't have to work at 51 weekends a year, right? Only take off Christmas, right? So whether it improves your culture from a technology stack, right? Improves your bottom line on a technology stack, right? All those things can become pieces of the benefits of having the proper technology stack.
And I think you covered our key takeaways while you were saying that, Gary. So, and like the last piece that I say, that use professional help, use Gary, use us, use whoever you like in this industry. We're, expert enough to help you to decide on your technology, your operational strategy, and kind of give you proper technology and proper reports and dashboard to make good informed decisions.
And on that note, B, if you would, could you go ahead and show the slide with yours and Gary's contact information? And as you do, again, the floor is still open for a few more moments if there are any other questions that you have. And as you ponder that, this is being recorded. I will be publishing this recording on our virtual learning archives on our member site. I'm sure most of you are familiar with that at least. And so if you came in late, I saw a couple of people kind of came in midway through. Don't worry, this is all being recorded and it will be published, and I will be notifying everyone once it has.
Thank you, James. The slide has, I'm sure you're circulating this document, or if you would be circulating information, there's mine and Gary's information. There is few collateral and data sheets on best practices that accounting analytics follows for some of our clients. And I guess that's everything I had, James, today.
Okay, I'm not seeing any other questions coming in chat, so I'll sound like an auctioneer, going once, going twice. Well, then a big thank you to both those in attendance and of course our two speakers on this topic, both B and Gary. Pleasure having you. We look forward to the next one, hopefully. And with that, we'll sign off. Once again, I'm James Hargrove, Communication Director for US Indoor. We thank everyone for being here, and we'll see you on the next one. Take care.
Thank you, James. Thank
All
you,
right.
Gary.
Thanks,
Thank you,
everyone.
everyone.
All right.